Today, we face a number of economic headwinds, including inflation well above the Fed's target level, higher interest rates than we've seen in many years, and large and expanding government deficits, both at home and overseas. Geopolitical tensions are boiling over into military conflict, and multiple national elections around the globe are scheduled this year. In short, there's a lot of uncertainty. I'm Chris Cebula, and I'm here with Mark Armbruster to discuss some popular safe haven investments that might be a fit for investors given our current economic backdrop.
No one ever knows what the future holds, but there are certainly times when the risks are higher than others. Compounding the risk for investors today is the fact that the overall U.S. stock market is trading near all-time highs, and valuations are currently at levels rarely seen historically.
People are certainly nervous. We're hearing a lot of questions about how to protect portfolios in the event of a stock market downturn. We reviewed the history of several asset classes with reputations for being safe havens and looked at how they performed during the more notable market downturns of the last century.
Let's start with one of the most conservative investment options, Treasury securities. Backed by the full faith and credit of the U.S. government, Treasury bills and Treasury bonds are likely the safest investments on the planet. Short-term Treasury bills are literally the definition of the risk-free rate in finance theory. Unlike corporate bonds, there's little to no credit risk with Treasury bonds. However, Treasury bonds, particularly longer-dated bonds, can be negatively impacted by rising interest rates.
Yet, during most bear markets, there's a flight to quality, with investors selling risky assets and piling into safer ones. This higher demand for government securities drives yields down and prices up, making Treasury bonds perform well. This makes them the ultimate safe investment during crises.
Exactly. Nothing is foolproof, though. Even Treasury bonds lost money in 2022 when the stock market was down about 24%. But historically, they've been a reliable safe haven during most crisis periods.
Another traditional safe haven is consumer staple stocks. These stocks are made up of companies that provide essential products such as food and beverages, household products, and personal products that are always in demand regardless of economic conditions.
With the non-cyclical nature of their revenue streams, these stocks tend to outperform the rest of the stock market during bad times. Historically, consumer staples have indeed outperformed the S&P 500 during crisis periods, but that's been a Pyrrhic victory since they still suffered double-digit losses during the last three significant stock market downturns. So while they've been defensive and have lost less money than the overall stock market, they still have lost money during those bad periods.
And what about precious metals like gold?
Right, gold often tops the doomsday list, but the record is mixed. Investors perceive gold as a hedge against economic declines and rising inflation, but this doesn't always ring true, as evident during 2022 when rising rates and inflation brought down the prices of stocks, bonds, and even gold. Gold has, however, been one of the strongest asset classes during economic downturns. It soared during the 1973 oil crisis and also held up well during the bursting of the dot-com bubble and the global financial crisis. However, gold can be volatile, so while it's often seen as a safe haven, it isn't without its risk as a long-term investment.
Silver, on the other hand, hasn't fared as well. Silver prices declined during 6 of the 7 crisis periods we observed, and long-term returns have also been muted, making it less attractive.
Correct. If you had bought silver back in 1980, you would have spent about $36 an ounce. Today, silver is trading just above $28 an ounce, a cumulative loss of more than 20% over 40-plus years, and that's before factoring in high commissions, storage costs, and inflation.
Let's discuss some non-traditional strategies like managed futures that could help us weather market turbulence.
Yeah, absolutely. Managed futures is a solid portfolio diversifier that uses a systematic trend-following strategy. These funds invest in futures contracts across various asset classes, including futures on stocks, bonds, currencies, and commodities. By taking long positions in futures assets with positive trends and selling short positions in those with negative trends, managed futures can potentially profit in both rising and falling markets. For example, during the last 4 bear markets, this strategy delivered strong annualized returns of nearly 26%, highlighting its potential as a valuable portfolio hedge.
Bitcoin is a new entrant to this category of non-traditional and, quote, safe haven assets. After all, it's supposed to protect against inflation and irresponsible government behavior, which is often a blame for economic and stock market downturns. Because it is a newer asset, we can only compare performance during the last 2 bear markets. So far, the data is not constructive. While stocks fell during these periods, the price of Bitcoin also fell significantly, and in fact underperformed stocks during both the COVID crash and the first 3 quarters of 2022. While we don't know if this will continue in subsequent bear markets, the available data suggests that Bitcoin trades more like a technology stock than digital gold, so we'd be cautious about its ability to provide safe anchorage in a storm.
So which of these assets would be best to hold if constructing a so-called doomsday portfolio? Given the historical data, gold, Treasury securities, and managed futures all experience positive returns in aggregate during these poor periods, even if their records aren't perfect. At the same time, consumer staple stocks, silver, and Bitcoin failed to offset stock market losses.
Holding a variety of different strategies as opposed to one reduces risk, as you are not holding all your eggs in one basket. However, we caution about shifting too much of your portfolio to these investments. Even though they have historically provided adequate relief during bear markets, total returns over all periods still trail a more traditional mix of stocks and bonds.
Beware the temptation to time the market, even if it seems obvious that the market is trending one way or the other. Trying to second-guess a long-term strategy usually reduces your long-term returns, but allocating a portion of your portfolio to safer investments can add solid diversification, downside protection, and peace of mind.
Remember, no asset class is infallible, though some are better than others for hedging stock market risk. A broadly diversified approach is best, and stock market downturns are typically brief, so it often doesn't make sense to disrupt a long-term plan for a short-term phenomenon. Thank you for joining us on this episode of InvestEd, and drop a comment on what steps you're considering to protect your portfolio